Hi, I'm Mark Hebner, CEO and founder of Index Fund Advisors, and welcome to IFA TV. Today, our guest is Samuel Hartzmark, who is the finance professor at the Boston College Carroll School of Management. He is the Hillebrand Family Faculty Fellow, and he specializes in asset pricing and behavioral finance. Welcome, Sam.
Thank you so much for having me. It's a pleasure to talk about some returns.
Yeah. In fact, what we do want to talk about is your paper that you wrote back in 2017, updated in 2020, I believe, titled Reconsidering Returns. Let's start off by explaining what we need to reconsider.
Well, I'd say on some level, the message of the paper is we need to consider what we actually are seeing when we're told we're seeing returns. So, what is
Uh-huh.
the most boring thing in finance you can talk about is how to think of performance, because everyone agrees we should be looking at a return formula, right? Whatever the current price is minus whatever price you paid for it plus some dividends. It's the most boring thing in finance. We all know it. We all love it. Everyone agrees it's the right thing.
Right.
What our paper points out is while everyone agrees it's the right thing, it's incredibly difficult to find that in real life.
Yes.
Almost everywhere you look, when you think you're looking at performance, you're looking at a different number that typically excludes dividends, and that's going to be a biased number. And if everyone agrees returns is the right number, it's the wrong number to be looking at. But unless you're very careful, it's the one that you get shown all the time.
Yes. That's quite amazing. I have to share with you the way I kind of gotten interested in this is we were celebrating our 25th anniversary. And so here we had our 25th anniversary coming up, and I asked our portfolio managers to put together a little analysis of what the S&P 500 was when I incorporated on March 5th of 1999. And they came back and said it was at 1275. And then I wanted to know what it was today, and it's at 5,000. But then she says to me, Kayla says, Mark, don't you want the total return? I said, well, of course. Isn't that what we always get? She said, no, what you see on CNBC and virtually all financial media is the price only return, which I'm now calling the partial return versus the total, right? And so
Yep.
I said, well, tell me what the total was. Well, she says, well, the first thing you should know is the return was 5.8% only for equities for 25 years when you look at price only. But when you throw in those dividends, it was 7.8, which is still a little below the 9.5 or so, 96-year average. But we had a couple bad things going on in that 25 years, but still much bigger and full 2% per year advantage. And so then if you went back to the start date, it was 3,758. And today, depending on what file you use, at the S&P website, they have a 1989 file beginning as total return. But in Morningstar, you can actually see a 1970 file. And when you see that, we're getting close to 24, I think today, getting close to 25,000. Then the Dow, which is among the worst representation of market returns, although I thought it was kind of interesting, the price return wasn't too far off, 5.83
Yeah.
versus 5.8. Total return at 8.3 was still fairly close. Maybe that's an accident or a coincidence. But anyway, that Dow today is at about 40,000. But if you look at the total return, it's more like 100,000. So we have made up our Dow 100,000 caps, which we'll be
Oh, I love
wearing.
it. That's a great hat.
It says, instead of trademark up there, it says TR for total return. Maybe we'll have to get you one. You can celebrate.
I need one of those hats. That's amazing.
So this started, and what's funny, I don't know, a couple weeks before this, I had heard your podcast on the Rational Reminder with my friends Cameron and Ben. And I listened to you at the end. I thought, oh, that's interesting. But somehow it didn't really sink in until I did this 25-year comparison.
Well,
So
it's striking once you see it, right? Like,
it's
you don't think about it, and it doesn't sound huge, like, so in this period, it's about 2%, historically about 4%, but 4% per year, over a number of years leads to very, very, very much bigger numbers.
it's huge. It's huge. So I didn't calculate the Dow from the beginning. Did you ever figure that out? I saw you had it at about 600,000 in your paper, but that was
Um,
2016, I believe.
y-
2017. Well, if you published 2017, it was probably 2016 data. Somebody at S&P said it should be around 1.6 million in
yeah,
today's value. So they're points, I guess they call them. I don't know what they call them. I hear the word value or points. I
yeah,
even see
no,
price. I see price sometimes. I guess it could be a price, but I'm not sure how that really relates.
yeah, no,
Anyway,
it's a price of something, but I don't know what it's the
yeah,
price of.
of what exactly?
Yeah.
I'd like to back up a little bit because you talked about that this was the total return formula, but
Hmm.
it is relatively modern that people have thought about it that way, really starting, I think, with the Miller Modigliani paper, which was 1961, I believe.
Yep, so 61, 62,
To
right around
somewhere
there.
in
Yeah.
there. And so I think of that as fairly modern since I was born in
Mhm.
1952. And so I think that's important. I think before we get on to some of those other questions, is a little bit of a background of how we got here and what
Yep.
people perceived investing as in those early days
Mhm.
and how it changed.
Yeah. So one of the things that was really fun writing this paper is we wanted to understand what is kind of the history of thought, if you will, of performance in financial markets. So we basically went and read every finance paper from about the 1890s through about Miller Modigliani in the 60s that had some discussion of stock returns and performance.
Right.
And what we found with those early years is confusion. That there were a lot of different concepts being kind of batted around, different conceptions of what it meant to buy a stock. So in those early years, I'd say the consensus was you shouldn't really think about buying a stock as an investment. It was like a pure gambling transaction. To
Right.
the extent you thought about it as an investment, people thought of it almost like as bonds, where like you should hold it purely for a dividend yield. There was a review article we found that basically said there was three distinct ways of thinking about a stock investment. One was for dividend income, one was for price appreciation, and one was gambling. And these were
Right.
distinct. So it's not like, like what does a return formula do? It adds in price appreciation and dividends together. And what you care about is, how much money you make. And in the early years, it wasn't that at all. It was like you could be this type of investor or that type of
Yeah.
investor.
Right.
Um, and so there was a lot of confusion. And there was, I'd say, a lot of logic from like commodities or bonds. Stocks were discussed relative to par value, which isn't really a coherent concept. Like there was just uh, it was a bit of a mess. And some people did things that were beginning to look like returns. That was somewhat contentious. So, for example, I think the first paper we saw that was doing something somewhat reasonable was in an argument about whether stocks should be considered investments. And the strong argument was no. They were trying to say yes, but they did all sorts of weird things. Like they included dividends, but I think like they, I forget if they threw out special dividends and kept normal dividends or vice versa. I don't know. It was the, our main takeaway from going through that literature is Miller Modigliani, which we take for granted,
Yeah.
was transformative and brilliant, and really solidified our way of thinking about this. But that and once you know it, it's obvious. This is what's known as the curse of knowledge, right? Like once you know something, it's very difficult to then think about how you view the world if you didn't know it. So, everyone in finance knows about returns. Everyone knows this formula because, it has been codified. We agree about it. Um, but that 80 years of literature before shows these are smart people, and this is a difficult problem, and it's not an intuitively easy problem, and it's one that very smart people struggled with for a very long time.
Right.
And there wasn't a clear consensus. So the world is such that unless you live in Germany, basically you're looking at a price index. So it's like that return formula excluding the dividend. So why is that important? Well, it's because the price drops by the amount of the dividend
Yep.
on a given date. And so this is a pre-announced drop, right? Like dividends are announced about a month before they go X. So basically what that's saying is on that date, whatever, say, the Dow Jones or S&P 500, whatever happens in terms of actual performance, the stated performance will be lower on that day by whatever the dividend yield is that day.
That's right.
And it's uninformative because dividends are irrelevant. That's why we put prices and dividends together in total returns, is because that's not making you richer or poorer. If what you care about is market performance, it's not, I'm going to pre-announce random noise going forward where some days it's too low and some days it's too high.
Right.
That's not what you want, which is why we've got the right formula of returns. And if you exclude it, just the higher the dividends are that day, the lower the market index will be, all else equal.
And so how does that affect the journalists reporting on the market?
So what we look at in our paper is tone. So we, very simple measures, like kind of how positive or how negative are financial journalists. We focus on the New York Times, the long data set. And what we find is that tone is, first off, highly correlated with performance, unsurprisingly.
Yep.
Better days, people are more positive or worse. But that controlling for whatever that level of performance is, there is a big impact by the dividends that go X that day, which the higher the dividend X date yield is, the more negative the tone is. Now, this is weird if you think that financial journalists are roughly reporting on market performance. But it's not weird if you realize that basically what's happening is the S&P 500, the Dow Jones, is systematically lower on those days. So what that big negative loading on dividends is telling you is that financial journalists are looking at the price index number that is the wrong number, and that's what they're writing about. They aren't debiasing things. They aren't, figuring out the right number, even though it's it's public what the right number is, but
Right.
you have to go through some effort to find it. And it's saying no one's going through that effort. They are looking on what's at the Wall Street Journal or on TV or whatever it is. That's what they're writing about. And that's why they have this big negative impact on a totally economically irrelevant bit that isn't telling you market performance, but is influencing the number that they get shown.
So you mentioned Germany.
Mhm.
Brazil is the other country.
Yep.
So far, we can't find any other ones. There might be a few others.
Israel is as well too, actually.
Which one?
Um, I've heard Israel.
Oh, wow. I'll have to look
Yeah,
into.
I
Yeah.
don't know. In our paper, we looked at the list of countries in the Financial Times, and they weren't on there. But
Right.
I actually bumped into an Israeli who made that claim. I haven't looked into it though.
So maybe you could tell the story just quickly as to how Germany came about displaying what they call a performance index instead of a price index.
Yeah, so exactly why I think probably it has more to do with time period. So Germany before I think the modern index is 89, I want to say, is the DAX.
somewhere in there.
But
Yeah.
before that, it was the big Frankfurt
Frankfurt.
paper. I forget what the yeah. And so that was a traditional price index. And then in the late 80s, they decided there was going to be a new index, and they created an index which is actually a total return index.
Right.
So basically, what it means is it has both prices and dividend appreciation in it.
Right.
And as you're kind of showing on the screen, like
Yes.
that's clearly looking at, say, what you would view in the Financial Times, which is just you'd have a picture of a German flag, and it would say 7% average return, and then a picture of Spain with a depressingly low number there.
Right. This is a
But
15-year average, by the way, but go ahead. Yeah.
Yeah, and so that's what actually gets displayed. And what the blue and orange is showing you is that these are totally non-comparable numbers.
Right.
Because what you should see is, in this period, the DAX was, a solid performer, not the top, not the bottom.
Right.
But what gets shown by default in, say, the US, whether it's the S&P or the Dow or the NASDAQ, that is a price index, not a total return index.
Yes.
The DAX in Brazil are the two examples where they actually are showing the total return. And of course, again, what I think is surprising, kind of from an academic perspective, if you will, it's like none of this is private information, right? Like
Right.
there is a price-based version of the DAX. There are now total return versions of the S&P and the Dow, but like when you open the newspaper, for the DAX you see total returns, and for the S&P you see price changes,
Yeah.
and these are just the wrong number.
So I have requested of S&P here, which now owns the Dow as well.
Mhm. Yep.
You can see if you click and go to the SP Global site here, the default is a price return. I've asked them to make the default the total return instead, and make people select the price return. And here you can see how close we are to my celebrating cap of 100,000. We're at 98,197. I don't know when that exact time was. It says today. I think they keep that up to date. But it's interesting. You can look at a long-term return here. You can see 11.8 from a total return, but you go to price return, you have to reset it. It was 9.35. So you can see what a difference this makes over these longer periods when they're averaged out and compounded, and how misleading it can be. Interestingly, if you look at fixed income, which is almost entirely income and very little capital gain in their price, I noticed that it's the opposite. All you see is total return. There is no price return. And so I asked them, I said, well, tell me, if the return is 98% of the time and you want to just show that return, why wouldn't you do the same when the return is maybe 30% on average? Maybe around the world, I think it's closer to 40. I saw in a lot of those countries, it's almost half the return is from dividends, shockingly. And so really, really a mess. And then I said, well, on your little scroll here, can we just get the total return maybe and the price return to start with? And then maybe over time, you could just show the total return and not even bother with the price. Interestingly, if you go to Bloomberg and you get on the Bloomberg page, here is a list of Bloomberg total return indices. They make a very big deal. It doesn't just say little TR. It says total return on virtually all of these indexes. And somebody who is involved in indexes at Bloomberg also showed me one of their screens, and you click on equity, and the default, maybe you can change that default, but the default he showed me was all total return.
So I think that's fairly recent, actually. So when
is that right?
first were writing our paper, which I'm going to maybe it was 2016 or something like that, or 2015. the default so Bloomberg could do both. Like,
Yes.
so they have the TR total return tool, but like the default ticker search at the time gave you a price-based one. And I actually have a buddy who works in industry, and when he first got his Bloomberg terminal, this was probably this is I don't know, maybe 20 years ago at this point. He
Right.
talked about how like out of the box, the default in a bunch of settings was price-based stuff, which was throwing from, like, it was like putting in his performance. He was like, I'm killing it. I'm beating everything by 3%. Like, what in the world's going on? And then there was a way to switch the default. So I would not be surprised if
Right.
now out of the box the default is the other way. But I do know historically, even for Bloomberg, there was a lot of price-based stuff for equities.
Yes. So I want to talk about the misbenchmarking of comparing
Hmm.
returns of maybe a stock picker, including his dividends or her dividends, versus the price only index. In 1 second, this is actually a petition I put together to give a nudge. Actually, Sam used that term in his paper, that someone needs to give a nudge to this industry, and I am the nudge. And so we're collecting signatures, and any of you watching can go to ifa.com/petition and add to our 284 current signatures. It's really hard to get signatures. Anyway, so we lay out sort of the case here and how I came about understanding these major gaps. And then we have a whole bunch of additional information, including another interview Sam did in the Rational Reminder, a link to his paper that we're discussing, this glaring difference you see here in the S&P returns from price plus dividend equals the total return. This reminds me, Sam, right after I dug into this, a local bank had an economic professor from a local university do a presentation on the
Hmm.
economic outlook. Okay, so I go to the little presentation. There's 100 people in the room, and he talks about GDP and interest rates and where they've been, and then he talks about the market. And he puts up a slide and he says the S&P return last year was 24.23%, as you see here. And I couldn't resist. I had to raise my hand. I said, well, that was just the price return. And he said, no, it wasn't. It was the total return. And it just hit me like a ton of bricks why this is so important. Here's a whole room of people thinking the market was only up 24%, when in fact, if you had a Vanguard S&P index fund, you were up 26.2, and you didn't
Yeah.
beat the index by 2%.
Well, and I also think this is really important. Like most of our paper looks at like daily things. It's very
Yes.
easy to identify. But if you think about these longer term effects, like investor behavior should be very different. If you think the stock market has a 5% return or like a 9% return, say,
Right.
in historically that's kind of in the ballpark of what that difference is. And if you're just always looking at the lower number and not realizing that the market actually is giving you that extra 3%, 4% of dividend yield,
Yep.
you've got a very biased view of the market. And there's lots of I think questions finance professors ask about, like, how is it that people seem to not be as in the market given its high returns? Why does it seem to kind of be underpriced relative, like what can cause these things?
Yep.
And again, not the cleanest result in the paper, but something we point out is a lot of these puzzles are consistent with, well, the world works where there's like a 9% return, but people behave as if there's a 5% return. And that's a fundamental mistake.
So, in the UK, investing in the market is not very popular. They would rather buy properties, and they literally count their wealth by how many properties you have and are renting. And that should be no surprise when you look at the 15-year of the FTSE 100, which is a common index there. The annualized return is 2.3%. I mean, that's worse
Yeah.
than a bond fund. Even the 6.2 isn't too bad, but it's probably closer to what they can get in property. And of course, property requires some human capital on top of their financial capital, but that's another topic. So the other thing, we just briefly touched on this, and this is this idea that there's one easy way to beat the market, and that is to benchmark it, bench your performance to a S&P index without dividends, the price index that we all see. And we contacted Jason Swag of the Wall Street Journal to see if we could get him to write an article. He said, Mark and Murray, both of us, he says, listen, I already wrote about that in 2011. Do you see?
Yeah.
And so he goes through here and he contacted a handful of people, including Mr. Kramer, who
Yep.
was comparing his returns to a price only index, and a bunch of people.
Oh, wow.
Back
Yeah.
in 2011. And so this is another big issue. So could you talk about that, relevant to maybe just a handful of stocks, even relevant to mutual fund performance?
Totally. So, I mean, one like the easiest way, which that article seems to be about, is say you really like you report performance relative to the price index. In that, the easiest way is you report your total return performance relative to a price index.
Right.
And I think that in terms of like more mainstream finance, doesn't tend to happen anymore. Like I've heard stories that this used to be somewhat common, and I have very much heard that it is common in some of the shadier bits of the market. So say maybe selling annuities to naive investors or things like that, that people will display these numbers.
Yes.
But so
Yes.
in terms of
Apologies to all the annuity salespeople, but go ahead.
no. So this was one example. I'm sure that there are many good annuity salespeople who don't do it, but
Go ahead.
yeah, no. So I think that it is like, and that is I'd say, given what we know today, just very wrong. So it's like most mutual funds say will report themselves relative to a benchmark. And that benchmark, I think, in like say what their officially filings are, tends to be total returns. My understanding.
Yes.
But with that said, in unofficial places, oftentimes different things get shown. So, for example, in our paper, what we look at is how, at the time, what Yahoo Finance was showing when you looked at mutual funds. And so they weren't doing total returns versus price indices. They were looking at changes in NAV, which is kind of like changes in prices relative to changes in the price index.
Right.
So this sounds better on some level, but actually it isn't, because changes in NAV aren't performance, but it's not performance in a way that's different than a price index, because there's, realized capital gains. There's all sorts of things that are going on that aren't in the, say, S&P 500 price index. This is a pure apples to orange comparison. These are two numbers that shouldn't be displayed together, but often are. And so we asked, well, does it matter? And what we found was that if you were a mutual fund and you beat the S&P 500 price index based on your change in NAV, so this had, these numbers shouldn't be compared, but they were, you discontinuously got big flows if you beat this benchmark. So that seems consistent with there being a class of investors who look at this, who respond to this,
Right.
allocate money to it, even though it's economically irrelevant. Two random numbers that are noisily correlated with what we know we should be looking at, but it led to big flows in the market.
Yes. Wow, we're accumulating lots of issues with that price only return, which brings up another really interesting question you ask in your paper here. I don't know if I can find the exact question. Oh, I did. I love this. You say, indeed, we defied readers to come up with an economic application for which the S&P 500 price index or the Dow Jones is the correct metric. Do you have any of those? You defy the readers. Obviously, you don't have one, but what have you heard from people as to why it might be correct?
I have not heard from anybody try to defend why it makes sense. The I mean, what we argue in the paper is that it's likely historical accident, right? Like the
Yes.
Dow started with railroad stocks in the 1890s, and someone with paper and pencil, and maybe this makes sense as an approximation. The Dow also price weights its constituents, which makes no sense as well too, because of course, price has no economic content. You can do a stock split, half your price, or double your price. That shouldn't half or double your weight in the index. But in the 1890s, these may have been shorthand to make it around, just like the fact that it was very hard to calculate these numbers. But
Right.
today, Excel can do this, and we
Right.
don't need to do it.
Well,
I
they
mean, I
already
think
have them. They already have all the total
yeah,
indexes.
no, now they exist. So I mean, like the hard work has been done. They're there, and of course they exist. Like I think the only thing that I could, like, if you were like, if I were to try to answer my own challenge, it would be something like, if there was a specific contract or derivative or something written on the wrong index, you'd of course want to use the wrong index. Like, why would you use the wrong number if we know how to calculate the right number?
It's really so elementary. What steps do you think are needed to get this changed? Let me say what I
Um,
mean by change. To
mhm.
make the visible index across the world so that the default index is the total return index.
So let me answer this two ways. Like one, from like an investor perspective, and maybe one more thinking about what the impediments are. But from an investor perspective, I think this is a very straightforward swap, which is you just need to start showing the right number.
Yeah.
Because most people, I think, are broadly ignorant of what is being shown. I mean, you were talking about the economist in the presentation who was like, I want to know how the market did. Here's what S&P did. Like, I mean, like there wasn't thought going into that. If you had talked about it, I'm sure he would have figured it out. But it's the default. It's what we get shown. It's what we think of. And so, to a first approximation, I think we need to change the default, and then people will go on not understanding what they're looking at or caring or thinking particularly deeply about it. But
Right.
what they will be shown is now the correct metric. And so their behavior will reflect that. And that is a good thing. That should just lead to better decisions, better behavior. Um, we're just getting people to pay attention to the right thing. So I think the investor side is very easy, and I think that would be a significantly good thing at minimal cost to do. um, then I guess there's the question of, well, if it's a easy to do thing that at minimal cost, why in the world hasn't it happened yet? And I have less of a good answer there. Clearly, I think there's a bit of a collective active issue of, like, if you were the only person showing a total return, but everybody else is showing the price index,
Yeah.
what would people think of? Um, Maybe there's some stakeholder interest of, people like their traditional index. It's kind of a default. They don't want to rock the boat there. I don't know what the friction is, but it seems,
We've always done it that way.
yeah, no, totally. It was good enough for the railroad barons. It's good enough for us.
So this is the website of the Index Industry Association, the IIA here. And here are a bunch of familiar names. Could you tell us, since you were at the University of Chicago, what CRISP is,
Mhm.
and maybe just a short little story on its incredible history, which I've written about in my own book, but go ahead.
Yeah, so CRISP is the Center for Research and Security Prices, I think,
That's it.
which is at University of Chicago. And really, my understanding is kind of, it was the first major data formulation of financial securities, if you will, kind of
Yes.
the
There's-
late, I think the early to mid 60s, kind of the first big database of equity returns. And so I think it's been hugely influential, first off, just in terms of a historical database. I think it's also very influential, Miller and Modigliani, early 60s. I think once data really came online, it also forces you to think about these things, right? Because
That's
you
right.
you start looking at price changes versus total returns. It becomes really apparent really quickly why total returns are important. So I think it also helped to crystallize a lot of these concepts in terms of returns. And then CRISP has also become a big index provider, that I think is widely used by a number of folks in industry.
Or Vanguard now.
Um,
In fact, Vanguard
it,
switched a lot of their
yeah,
funds to CRISP. Yeah. Of course, Gus
yeah.
Sauter was also a University of Chicago graduate who ran the Vanguard indexes. Anyway, go ahead.
Yep. And sorry, yeah,
So Chris,
I'm
Chris
yeah.
also did the very first long-term study. It was actually created, funded by
Mhm.
Merrill Lynch, where they came up with the 9.3% return for historical stock returns. I think they used the New York Stock Exchange. I'm not really sure.
Mhm.
And shockingly enough, that number is still pretty close to that. As it
Yeah,
turns out, the cost of capital of firms has remained relatively constant over long periods of time, although there's a very wide distribution of standard deviation of around 20 or something around that
yep.
number. And so it's quite volatile and hard for people to see. So anyway, when you see the list of these 1, 2, 3, 4, 5, 6, 7, 8, 16 different index firms around the world, you can see that this might be difficult to get all these people to agree. So any ideas on any steps that you could provide to me to help me in this mission to get the world to change? Any thoughts?
It's a hard one. It's to me, I think the biggest thing is maybe even less the index providers themselves, because again, in this modern world, there is a price and total return index for all of these things. That's part of
Right.
where it makes it so puzzling. And so, to me, I think the question is like, well, how do you get CNBC and the Wall Street Journal, say,
Yeah.
to shift to the right things? Because I think that once there are big public facing steps, that everyone will follow suit. Because again, there's a little bit of a kind of a network game going on of uh, being the first mover or being odd or being different. So, I mean, to me, it would be like, if say the Wall Street Journal and CNBC got together and really publicized, like, okay, here's the deal. Like, on this date, we're going to change what we're displaying and maybe coincide with a few months of
Right.
here's why, right? Like, here's what the current is, here's what the past is, this is why there will be this update. Once there's this update, you can forget about it. It'll go, things will go back to the world where you don't need to care. Then I think there would be, if there got to be a critical mass, I feel like other people would follow suit. And you would still have, people misusing numbers, because people misuse numbers all the time in all sorts of places. But I think, to me, the issue is just the default. Like, what is the standard thing that gets shown? And that default needs to change.
Yeah. Well, Sam, listen, I really want to thank you for making this huge effort. Maybe you could guesstimate how many hours it goes into creating this paper with your co-author, by the way, David Solomon. Thank you,
Yeah,
Dave,
yes,
for your
no,
contribution as well. Uh,
no,
but
no. And
but
I think that
just so
sentence that you
people,
really liked, that I think that was Dave's favorite sentence of the paper, I think. So I'm
which one?
glad you highlighted it. Oh, I defy something like, we defy you to come up with any reasonable economic, that
Exactly.
is, he was so happy to get that sentence into the paper.
It's the
Um,
punchline. Yes.
yeah.
So, but
I,
listen, just for the audience sake, I think I
mhm.
mentioned to you, it was really a little surprise to me when I first started studying investing in general, that there was this incredible resource of academic peer-reviewed papers. And
Mhm.
I was just astounded by how much effort and time must go into those. I mean, Fama likes to say that him and French, Eugene Fama and Kenneth French, debate every word in the paper. They go
Oh
back
yeah.
and forth. So ballpark, how many hours are involved in creating this, 50-page paper? Just curious.
I mean, I would guess at least say, I don't know, 6 months full-time work, if not a little more. Like, I mean, because
That's
it
a
goes in
thousand hours.
phases.
That's 1,000 hours.
Yeah,
Two
I'd
thousand
say that's
hours.
ballpark in there.
Okay.
Because yeah, and it goes in fits and starts. You kind of make a draft, and then in this peer review process, you end up, maybe you do half to two-thirds of the work, but then you send it to very smart people whose job is to really kick the tires and poke holes and ask tough questions, and
Yeah.
then it's a
They
lot
call
of
those
work to.
referees, by the way. They call those referees
Yes.
who challenge the statistics and all the assumptions. What are there? Maybe 4 or 5 of them at a time? It depends
So
on
it
the journal.
depends.
Yeah.
Most finance papers, I'd say, are like 2 to 3.
Okay.
Econ journals tend to be more in the 4 areas. Yeah,
Yeah.
truthfully, I forget how many referees we had for this paper. I want to say 2, but that's just a guess.
Yeah.
But you end
So,
up, they'll write kind of a, I don't know, 5 to 10 page kind of almost paper about your paper saying, I read the paper and I thought it was really interesting, but here
but
are like the questions I had. This is why I thought this table was garbage. Can you
right.
convince me it's not garbage? And that's kind of the process we go through.
So I just think that's important for all our listeners and viewers today to realize 1,000 hours roughly spent in researching and analyzing this. And maybe you're hearing this for the first time. You spent maybe an hour with us, and how much more weight Sam and his fellow academics have in your making decisions. And this was such a eye-opener for me when I first became aware of all these academic journals. I was a nuclear pharmacist in my previous career. And of course, we had medical journals, the Journal of Nuclear Medicine, and we always went there and read the latest paper and this and that. And somehow I thought for investing, you just have to open up the Wall Street Journal and get your information there. So I want to thank you for all of your toiling, probably in that room, sitting there
Yeah.
late at night when family and friends would probably rather have you with them, but doing this service for investors and for students. And I think sometimes it's not recognized to all the work and the effort and the dedication that you put into this. And I want to thank you on behalf of all us investors and all the advisors in this business. And because of your efforts, I think you're going to make my job here a little easier in nudging the index providers in the financial media throughout the world to switch to this. By the way, I have targeted a January 1st, 2026 date for the changeover, just as an initial proposal. And I'm hoping that we can make some progress. And your discussions today, I think, will help a lot. And so thanks once again.
Well, and I'd like to say thank you because we toil and write these papers because we hope it's relevant, we hope it's interesting, we hope that the word gets out. So by having me on, letting me talk to you about it, trying to actually be the change agent nudger, I think that also really helps to validate the research. So thank you very much for having me and talking.
All right, Sam. Thanks so much. We'll talk to you later. Bye-bye.
Bye.